Palantir stock could fall 17%. This is the title of a Forbes article that just came out. So let's break this article apart piece by piece and make sense of the claims, take a look at the proof, and then decide, does this mean that we should go ahead and sell our Palantir shares? Does this person know something that we don't know? Or does this mean that we should just double down on what we already have? Or just hold on to our long positions and just let things ride out because we're generally not short-term investors here. So pulling up the article, we can see Palantir Technology stock could fall 17%. Starting off, when Denver, Colorado-based Palantir went public at $10 a share in September 2020 through a direct listing, I was less than enthusiastic, this author says. And this links you to an article which basically says he's not enthusiastic about the company because it burns piles of cash, which we're going to address later, and its governance structure is investor unfriendly. Now, since then, its shares are up 140%, while the NASDAQ rose 23%. And he's asking, is this justified? Is this not justified? Should we be worried about a 140% increase? Was I wrong? One Wall Streeter Melius research analyst, Carter Copeland, sees the stock as overvalued since its price target of $20 per share for Palantir, according to Barron's, is about 17% below where it closed on April 9th. So right now we're sitting at right around $24 a share. This one analyst thinks that it should be at $20 a share, and that's where this author is getting that 17% overvaluation number. Now, does this make sense? I mean, maybe. When I made my very first video about Palantir, I said a perfect price, a price that I'd probably throw my entire savings into for Palantir would be about $14 a share. But I also said, that's probably not going to happen. I doubt $14 a share would ever happen because that would be like a value investment at that point. It'd be just insanely cheap at that point. And I am okay with buying a slightly expensive company as long as that company is great. I would way rather buy that company than a okay or poor company selling for a huge discount, because that company that you're buying that's great in the long run, chances are is going to do much, much better than the severely discounted okay or poor company. So that's why I was okay with a slightly overvalued Palantir. I mean, everyone knows a price to sales of around 40 is super high, but that's because we're banking on this company producing a ton of cash in the future as long as it can follow the trajectory that it is on. Now, Copeland's complaint is Palantir is not growing fast enough to justify that valuation. 47% increase in revenue in the last year. That seems pretty fast to me for a company that is doing hundreds of millions of dollars in sales every single year. They also say that its governance structure ensconces the powers of its three co-founders, investor Peter Thiel, CEO Alex Karp, and President Stephen Cohen. Now, I will say that that is the most valid complaint about this. They do have a ton of power. There's no doubt about that. Their voting power is massive in Palantir. And this is not something that we should just look over. This is very important, and it's a very valid claim. Now, what risks does this necessarily carry? I'm not really sure. But as a shareholder, you also want to carry over some of the power of a shareholder. Through me, it doesn't really change my situation a whole lot because I don't own a significant percentage of the company. I probably own 0.0001%, or probably maybe even a few more additional zeros. I haven't done the exact calculations, but my vote on a change in the company isn't going to make a huge difference, but it would matter more if I'm owned, maybe 3-4% of the company or something like that. So they do have a ton of voting power, and it's regardless of how much of the stock they actually hold and own. Now, Palantir's Q4 2020 earnings report. Palantir's latest earnings report featured better than expected revenues and a big loss, according to CNBC. It lost 8 cents a share, while revenue of $322 million exceeded the Refinitiv survey number by over $20 million. So it exceeded expectations there. Palantir's government business grew much faster in 2020 than its commercial business. Its total revenue increased 47% from about $743 million to $1,093 million, just over $1 billion in 2020. Its government business soared 77%, while its commercial business rose 21%. And they're saying that this is a potential issue because their commercial business just simply isn't keeping up, or they're trying to claim that the commercial business isn't doing all that well. And I wanted to pull something from the actual Q4 earnings report that talks about their commercial business and what we should really focus on. And they say now, in terms of commercial customers, This was a big year for commercial customers. A lot of expansion. The right way to look at this from our perspective is the amount of growth we had in US commercial, because they had a significant amount of investment in specifically US commercial. And this is where we're seeing a ton of huge partnerships with massive companies like BP, Amazon, other massive companies within the US or headquartered in the US. And they say that that resulted in 107% growth if we just take a look at the US customers' growth. So that's an important factor to determine on the potentially sluggish commercial side of the business. And they also cited how the disparity in the fourth quarter was even more significant. Also, they talk about how the CEO, Alex Karp, wants Palantir investors with a short-term focus to just basically get out of here. Get the bleep out of here, because he doesn't want short-term investors. He doesn't want people who are just going to cause the stock price to fluctuate wildly, which, I mean, it has fluctuated wildly. He wants people who are investing in the company to stay with the company long-term. And I think that that's a good way to think about it. If you're just trying to ride for, 2-3 months, maybe a swing trade or something like that, it might work out for you, but in my opinion, it's basically a flip of a coin. For me, I said from the very beginning, there is the downside potential here. I mean, we could even, 17% might even be a low downside potential. It could be potentially 30, 40% short-term downside potential, but I don't really care because I'm in it for the long term. If this thing went down 17%, I'd buy more. If it went down 40%, I would buy way more. I would love for this thing to go down 40% in the short term, as long as all the other fundamentals stay the same. That would be great. Now let's talk about their growth potential. Palantir has high hopes for growth this year. For all of 2021, Palantir expects revenue growth of more than 30%. They actually expect about 37% annualized growth through 2025 because they expect $4 billion in sales in 2025. For the March 2021 ending quarter, Palantir forecasts 45% revenue growth to $332 million. And they said that in their last earnings report, so we shall see if that actually pans out. But I mean, 45% in a quarter, who can complain about that? 30% year over year. With a $1 billion company, who can complain with that? I think if they're able to hit that 30% mark year after year, we're going to see the stock price increase dramatically, because people are going to say, hey, this thing's increasing 30% year over year. I need to hop on that train. And I kind of feel like hopping in now is, hopping on the train before it leaves the station, in my opinion. Of course, this is not financial advice. Do your own due diligence as well. Now here is another concern that I hear all the time, their cash burn rate. Palantir's operations continue to burn through cash at a rapid clip. Since 2018, net cash used by operations increased 662% to about negative $297 million, as revenues increase a relatively paltry 84%. So an 84% increase in revenue is paltry. I mean, if you compare that to their 662% figure, sure. Now, if we go back over to their earnings report, we can see some more context around this information instead of those select figures. Fourth quarter adjusted gross margin was 84%, which was up from 81% the same quarter the year before. And gross margin, if you aren't aware, is your revenue minus your cost of goods sold. And they say the year-over-year improvement in gross margin was driven by the increased automation and efficiency in the delivery of their software. This is where it gets really important, though. Total fourth quarter adjusted operating expenses were $186 million, which includes approximately $19 million in employer payroll taxes related to stock-based compensation. This is really important. Stock-based compensation and the relative expenses that Palantir has taken on because of stock-based compensation. Not only are they paying that, but they're also paying for the taxes having to do with that. Excluding these expenses, total fourth quarter adjusted operating expenses would have been $167 million. Fourth quarter operating income, excluding those stock-based compensations and related employer payroll taxes on the stock-based compensation, was $104 million. So their fourth quarter operating income would have been $104 million if it weren't for that stock-based compensation and the taxes on that compensation. This is because startup companies like this pay their original employees in stock options, and now these employees are starting to exercise those options, And because of that, Palantir is taking on a ton of paper losses. But these losses don't last forever because the options do not last forever. And now that the company is public through their direct listing, they are being exercised. And if they weren't exercised, there actually would have been a profit. And this means the full year 2020 adjusted operating income, which excludes stock-based compensation, excludes the payroll taxes that go along with that compensation, and excluding the one-time cost of doing the direct listing in 2020, would result in a margin of 17%. So it's not an unprofitable company, but they have had expenses in the recent years that have led to no profit. However, in my opinion, this is just simply not a concern because the first employees of the company are just finally getting paid. That's how I'm thinking of it. And we want these people to get paid. It's as easy as that. Yes, that is shareholder money, but they're the ones who built this company. And that's kind of how I'm looking at it. Going back to the article, they say Palantir is undergoing changes in the timing of revenue recognition, billings, and collections from its customers, and that has messed up their financial statements a little bit. Basically what happened here is Palantir used to take a huge upfront payment from the organizations that they were doing contracts with. Like they would receive multi-year payments all up front, and then there would be some deferred revenue. And then they kind of changed that, so it messed up their financials just for a short-term period. But now in the future, that'll be smoothed out and it won't look quite as weird on their financial statements. And then finally, they say, given all this information, CEO Alex Karp plans to sell his shares. But then they also say that he plans to sell his shares because he has all these options that are set to expire. And if he didn't sell any shares, he'd have a $12.8 million tax bill. So he's likely to sell some shares to pay for his tax bill. So taking all this information into consideration, again, yes, there is the potential for this thing to go down 17%. There's the potential for it to go down even lower. But that would simply mean to me, I would buy more shares. I would love for this thing to go down 40% in the short term because it's a very high conviction stock for me. That would almost be the best thing that could possibly happen for a long-term investor, for this thing to go down 40%. That way we can get some real cheap Palantir stock. So sure, they brought up some good points. I think we have some good counterpoints as well. I'm not concerned by this, and I'm personally still in it for the long haul. So if you enjoy this breakdown, make sure you like this video, do the subscribe, do all the other things. And I would just like to thank you for watching, and I hope you have a profitable day.